You ever look at a company's annual report and just get that feeling, that you're not really getting the full story? Well, today we're diving into the fine print. We're going to uncover the risks and secrets that companies have to reveal, and it's all thanks to a really powerful rule called IFRS 7.
I mean, think about it. Any public company will show you its profits, its assets, sure. But what about the really risky investments they're making behind the scenes? What about those hidden dangers that could, bring the whole thing crashing down? That's where the real story is, and it's what has caught even the experts totally off guard in some of the biggest financial meltdowns.
You can think of a company's financial report kind of like an iceberg. The numbers you see right on the surface, the profits, the cash flow, that's just the tip. The real danger, all those hidden financial risks, they're lurking just below the water. And honestly, understanding these hidden depths is what separates the really smart investors from, everyone else.
So how do we actually see below the surface? Well, after seeing way too many companies just collapse from risks nobody saw coming, the world's accountants got together and created a rulebook. It's a standard designed specifically to shine a huge bright light on those hidden risks and force companies to be a lot more transparent.
And this right here, this is the core mission of IFRS 7. It's all about giving you, whether you're an investor, an employee, or just a curious observer, the information you need to truly get what's going on with a company's finances and the risks it's taking on. In a nutshell, it's all about forcing transparency.
And what's great is that this whole thing really just boils down to two simple but incredibly powerful questions. First, what are all these financial instruments and how much do they actually matter to the company's bottom line? And second, okay, but how risky are they? Pretty much everything inside IFRS 7 is designed to get you clear answers to those two questions.
So let's tackle that first question. How important are these things? Well, IFRS 7 essentially makes companies create a super detailed map of their financial toolkit, showing us exactly what they're working with.
Okay, so the standard requires companies to sort all their financial assets and liabilities into these neat, clear categories. Are they being valued at their current market price, which is called fair value, or are they based on their original cost, which is known as amortized cost? Now, I know that sounds like a bunch of accounting jargon, but it's not. It's a really fundamental sorting process so you can understand exactly what kind of financial tools a company is using.
Right, so once we have that map of what the company actually holds, the very next step is to understand the dangers. And this brings us right to that second core question of IFRS 7. Just how risky are these financial instruments?
And the standard is super specific here. It says the disclosures have to focus on the major risks that come from these financial instruments, and while there can be a ton of them, IFRS 7 really zooms in on three big ones that every single investor absolutely needs to understand.
First up, we've got credit risk. This one's pretty straightforward. It's the risk that someone who owes you money just doesn't pay you back. Simple as that. Imagine your biggest customer suddenly can't pay a massive invoice. That's a fundamental and, potentially devastating risk of doing business.
Next up is liquidity risk. Now this one's a little more subtle. A company can look fantastic on paper, right? Lots of profits, tons of assets, but it can still go bankrupt if it just runs out of cash. Liquidity risk is that danger of not being able to pay your short-term bills, like payroll for your employees or what you owe your suppliers, because all your money is tied up in stuff you can't sell quickly.
And the third one is market risk. This is the big external risk that your investments are going to go up or down because of things you have absolutely no control over. We're talking about a sudden change in interest rates, a wild swing in currency exchange rates, or a stock market crash. It's basically your exposure to all the turbulences of the financial world.
So here's how these kind of abstract ideas play out in the real world. Credit risk, that's your biggest client going bust. Liquidity risk, that's a sudden cash crunch right before payday. And market risk, that's your whole investment portfolio taking a massive hit because of some unexpected currency shock. IFRS 7 forces companies to tell you exactly how they are managing their exposure to every single one of these scenarios.
So, okay, after all this talk about accounting rules, why does any of this actually matter to you? Well, it's because understanding these disclosures turns you from just a passive reader of a financial report into an active financial detective.
And listen, this isn't just for Wall Street analysts. This is a seriously powerful tool for anyone, investors, employees, even just curious citizens, to see beyond all the glossy marketing and get a true picture of a company's financial health and, crucially, its ability to handle the tough times.
So, how do you become a financial detective? It's pretty simple. First, always go past the big, bold numbers on the front page and dive deep into the notes to the financial statements. Trust me, that's where the real story is. Next, use those disclosures to map out the company's financial toolkit. Then, find the sections where they talk about credit, liquidity, and market risk. And finally, look for concentrations of risk. Is the company betting everything on just one customer, or one country, or one currency? That is a huge red flag you need to know about.
So, the next time you pick up an annual report, you've got a choice. You can stick to the surface, or you can use the map that IFRS 7 provides to go and explore those hidden depths. The real question is, what secrets are you going to uncover?